I'm going to kind of walk through chapter 17 in our investment management book, which is the Macroeconomic and Industry Analysis discussion. Where we're going with this, chapter 17 deals with basically the economy, the macroeconomy, the global economy. We're going to start there. We really focus mostly on the U.S. economy. From the U.S. economy, we could take a look at industry. So that's the second part of this chapter. Industry focus, industry analysis. Then we're going to move on into chapter 18, which is going to take us into the stocks, company analysis. We're going to look at some valuation models. And then I believe chapter 19, financial statement analysis. So what we're seeing here is what's sometimes referred to as a top-down analysis, a top-down approach to analyzing stocks. We start at the very top with the economy, we move on down into the industry, and finally we end up with the company. We analyze companies, we're looking at strengths and weaknesses, opportunities and threats. We're going to do financial statement analysis, and again, ultimately what we're trying to do is identify value and identify companies that may have value to invest in as we build a portfolio. So when we start talking first then in your textbook about the global economy, one of the things we talk about is the exchange rate. An exchange rate is simply the value of one currency expressed in units of another. Okay? So if I were to give you the yen per dollar exchange rate, and let's say it's 80. Okay? That's 80 yen per dollar. This actually is the value of a dollar. An exchange rate gives you the value of the currency that's expressed in the denominator. Okay, so if we had yen per dollar to be 80, at some other time we were looking at it and the exchange rate had changed, yen per dollar to be 100, you can see the value of the dollar has changed. Now, what impact does that have on U.S. imports and exports? Well, if we go from a dollar being worth 80 yen to a dollar being worth 100 yen, then that means for the same dollar, we can now get more Japanese yen. This is going to make imports cheaper. Imports in the U.S. become less expensive. Right? Because now the same dollar buys us more. Okay? So as imports become expensive, because it's not good for everyone, this actually hurts U.S. exporters because it has made U.S. goods more expensive abroad. It used to take 80 Japanese yen to purchase a dollar. All right, so something that cost $1 in the United States was going to cost 80 Japanese yen. Now that same item that costs $1 costs 100 Japanese yen. So as the dollar strengthens, and that's what has happened here, I should have written that. This is the U.S. dollar strengthens. You can tell the U.S. dollar has strengthened because the exchange rate, right? Remember, the exchange rate gives you the value of the currency that's in the denominator, which is dollar. So the dollar went from being worth 80 to 100. So that's the dollar strengthening. Imports become less expensive, hurts U.S. exports. We could reverse that. What if the yen per dollar exchange rate had been 100 and now the yen per dollar exchange rate has changed to 80? Well, this is going to be a weakened U.S. dollar. We can tell that because we can see the dollar went from being worth 100 to now it's only worth 80. Guess what? Imports are going to become more expensive now, aren't they? It used to be that every $1 we had would purchase 100 yen so we could buy something. Now every dollar we have only raises 80 yen. So something that cost in the, that we're purchasing abroad, we're purchasing from Japan, is going to cost us more. It's going to be more expensive. More U.S. dollars will need to be used to buy that same item. That's the bad news. What's the good news? Well, it helps U.S. exports, right? Because now goods in the United States have become cheaper. It used to cost 100 yen to buy something. Now it only costs the Japanese consumer 80 yen to buy that same item in the United States. So we can see how when the U.S. dollar strengthens, it helps us in terms of consumerism, right? Because we're able to buy the goods that we want less expensive, but at the same time it hurts our balance of trade because we're importing more than we're exporting. A dollar that weakens is going to help our trade deficit because we'll start exporting more than we import. Right? So that's really the global economy. Now let's move down into the domestic macroeconomy. And as we do that, I'm kind of jumping the gun a little bit, but in several pages, we're going to see a business cycle. All right, and I'll revisit it when I turn the page and I get to that point. But in our society, in our economy, we're concerned about production. We're concerned about gross domestic product production. And so I'm going to draw our little business cycle here. This is our expansion. And what we're plotting here are changes in gross domestic product, GDP. We've got our peak. We've got our contraction. And we've got our trough. And then we go back, because it's a cycle, it repeats, doesn't it? Then there's another expansion, another peak, and so forth. Okay? So what are some of the things that impact our society, impact our economy? And again, what our business cycle is plotting here, or what I'm plotting that results in our business cycle, is change in GDP. GDP is not the same. In fact, I'd want you to know the difference between GDP and GNP, gross national product. GDP is a value of all of the goods and services produced domestically. That would be in the United States, right? All the value of goods and services produced domestically. It has nothing to do with ownership, but rather where was it produced? And if it was produced here, it's part of GDP. And that's important because even though Toyota may have a Toyota plant in Tennessee, granted that's ownership of, profits are going to be going to Japan. Toyota profits go to Japan, it still helps our economy, doesn't it? Because goods and services are being produced here. We have workers here. We've got labor. We've got resources. We've got supplies. So GDP is measuring the value of goods and services produced domestically, regardless of who owns it, of who takes ownership. GNP is gross national product. Gross national product actually would not include the Toyota production in Tennessee. Gross national product is simply the value of all the goods and services produced by U.S. owners, U.S. producers and suppliers anywhere in the world, regardless of where it is. So that's gross national product. So GDP is really more of an indicator of where our business cycle is, because we're concerned about the production. Who cares? Well, we do a little bit, but, without regard to who's actually doing the production. So a rapidly growing GDP is going to signal really an expanding economy. Okay, at some point we know our GDP is increasing, but it's starting to slow down. It's increasing at a decreasing rate. Finally, it's going to hit its peak, right? And there's only one way it can go once it hits its peak. It goes down, right? And so then we move on down as we move into a contraction or a recession. A recession is 2 consecutive quarters of a decrease in GDP. Different things are happening in our economy. And then finally we hit rock bottom at the trough and we come back into a new expansion. So your textbook runs through some of the different economic variables, such as employment. Now, it should be somewhat obvious to you that we would expect employment to be increasing as we go into our expansion, right? Because one of the ways that we're able to expand is businesses are producing more. And generally the way they produce more is they hire more workers. So we typically expect employment to increase. Unemployment will be declining in an expansion. At some point when we around the top and hit the peak and move on into the contraction, well, because the economy is slowing down now, consumers aren't buying as many goods. We hadn't even talked about inflation yet, but inflation has gotten high. Then businesses aren't going to produce as many and they'll start laying off people. And then unemployment starts to rise. Employment, the number of people that are employed starts to decline. Unemployment starts to rise. Your textbook talks about inflation and interest rates. So think about the expansion. And think about yourself. Think about, all of us borrow money from time to time because we want to buy a car or a house. We want to take out a loan for something. Businesses want to borrow money. And so wouldn't you prefer to borrow money in a low interest rate environment? Yeah, sure. If you can borrow money in a low interest rate environment, you're more likely to buy that car or buy a house. Businesses are more likely to borrow money so that they can expand. Okay, so my thought is, as we think about our expansion, we probably have low interest rates leading into this expansion. That's one of the things that's helping fuel this expansion, is that businesses can borrow money inexpensively and consumers can borrow money inexpensively. Okay, now think about inflation and interest rates. So let me remind you about something. The nominal interest rate, which is the stated or quoted rate of interest. A lender is going to include some real rate plus various premia to compensate them for risk. But even the government bonds are going to have some inflation risk generally, right? The real rate of return, the real rate of interest it's a real risk-free rate. It's an opportunity cost of funds. If you borrow money from a lender, minimally the lender is going to charge you an interest rate simply at a convenience fee, if nothing else. It's an opportunity cost of funds. Because they're letting you use that money, they don't have the money for investment. Okay? So minimally there's going to be some real rate. Let's say the real rate is 2%. Well, a lender is going to charge an inflation premium. If they believe inflation this next year is going to be 3%, then the nominal rate is going to be 5%. So my point is that, remember, we've got low interest rates as we kickstart this expansion. Low interest rates. That's helping fuel the economy. And part of the reason that interest rates are low is inflation is low. There's no reason to think that, that price levels are really, really high. And so inflation is probably relatively low. Interest rates are low as we start our expansion. As we go through our expansion, at some point, inflation is going to rise. Think about what causes inflation. Inflation, and what is inflation? Inflation is general price levels, increases, right? So if price levels start to increase, then we're going to expect to see inflation, right? Inflation would capture that. Well, as we go through our expansion, remember that more people are going back to work, so people have more income, more discretionary income. People are starting to buy things. The consumer sentiment is really pretty high. People are optimistic. And so when they're optimistic, they start buying things. Now, let me just show you, let me remind you, here's price on this axis, quantity here. Here's our supply curve, and here's our demand curve. And where those two curves cross gives us the equilibrium price. At this price, let's call it P1. The demanders demand this many, and the suppliers will, where'd that come from? And the suppliers will supply that many. All right? So the markets will clear. That's the market equilibrium price. Now, let's hold supply constant, which may not be correct, but let's hold supply constant. And now everyone has more money. We've all gone back to work. Businesses are producing. People are getting raises again. We're in a great expansionary period, right? People have more money to spend. It's going to increase demand. We would expect our demand curve, aggregate demand, to shift to the right, to reflect the fact that people want more goods and services, and so they're going to buy them. Look what has just happened to the price levels. Because the equilibrium price is where the two curves cross. And this crosses higher here, doesn't it? Okay? So prices are going to increase. So what I'm saying is, at some point in our expansion, we're probably going to expect prices to increase. Okay? Because demand increases. Now, again, I don't want to get too fancy on you, but initially, even though right away we might experience some more demand, I don't think we're necessarily going to see an increase in price levels. Because remember, as the economy is growing, suppliers are starting to produce more too. So we're also expecting to see an increase in the supply curve, or a shift in the supply curve. So if you'll notice, we don't necessarily immediately see a price increase just because demand increases, because we also expect supply is increasing. Where we will see an increase in price levels is when, if this is supply, here's demand, here's our shift in the supply curve, but here's our increase in demand. Our change in demand is greater than the increase in supply. The supply curve absolutely shifted to the right, but the demand curve shifted up by more than the supply curve shifted. So there's now an imbalance. There's a greater demand than supply. And when there's a greater demand than supply, you know what's going to happen to prices. Price levels would increase. All right, now let's see what happens to our interest rates when price levels increase. Well, let's see, we go down here to 3.5%. Now we're going to say inflation is 3.5% because demand has increased greater than supply. That means interest rates are probably going to increase. Now, when interest rates start increasing, now businesses don't want to borrow as much money. Consumers don't want to borrow as much money. People will start actually saving money in a higher interest rate environment. And so they start pulling that money out, and they start putting that money away. They're not buying goods and services any longer. They're not going on vacations. They're putting the money back. And so that's going to, even though that's a good thing for people to save money from a fiscal type policy, or from a macroeconomic view, there's less demand, right? All right. So that was GDP, that was employment, inflation, interest rates. I'm going to jump over budget deficit for a minute. Your book talks about budget deficit, but it also talks about sentiment. And that's talking about consumers and producers, whether they are optimistic or pessimistic. It's really important. Consumer optimism is really important. What's kind of interesting when you're watching the news in the fall, like around Thanksgiving. There's all the Black Friday sales. The Black Friday sales, that it's not so much the sales themselves, but it sends a strong signal about consumer sentiment and how much what retailers can expect going forward into the Christmas season for consumers and consumer purchases. Consumer sentiment is very, very important. If they have confidence in the economy, they're probably willing to spend more. They're probably willing to borrow money and buy the big ticket items like cars and boats and homes and things like that. If we're worried about the economy, if we're pessimistic about the economy, we're not as optimistic. We're not willing to spend as much. Okay? The last one is that we talk about here is the budget deficit. And that one's pretty important. You know what a deficit is. That's when, you've got money that's coming in, right? You got your inflows and your outflows. And when you have more going out than you have coming in, you've got a deficit. And what do you do? Well, let me ask you, what if you've got some commitments already and it turns out that you're spending more this month than you're actually going to have coming in this month? That's not a good place to be every month, but we can pull it off for a while. What do? We borrow money, right? We can go to the bank and take out a short-term loan. We can use our credit cards, right? That's what we're going to do. Well, when the government does it, and they do, don't they? They run a budget deficit. When the government spends more money than it has coming in, then guess what? It has to borrow the money. And the more money that the government borrows, if you'll work with me here for a second, let's assume that this is the price of money, which is the interest rate, and here's the quantity of money. Here's the supply of money, and here's the demand for money. Let's just hold demand, or rather, let's hold supply constant. And I want you to think about, you got the U.S. government, you've got businesses, and you've got consumers. U.S. government, businesses, and consumers. We all need money. We all need to borrow money. And so if the government comes in first, which they do, I don't know why that happens, the government comes in and borrows the lion's share of the money that's available. There's only so much credit. And the more the government borrows, the less that's available for businesses, right? Now here's quantity is increasing this way, and so it's decreasing the other way. So if the government takes a lot of the money, which that's what we mean because they have to finance their deficit, then basically that lowers the supply. Supply is decreasing this way. There's less money that's available to businesses and consumers. Just basic supply and demand. Hold demand constant. It's going to show us that the interest rate is going to increase from P1 to P2, right? Because there's less money that's out there, but the demand is still there. The government took more than their share, if you will. So the budget deficit is really important. It affects the economy because it affects interest rates. Your book talks about demand shocks and supply shocks. Well, okay, so we're talking about the demand curve and the supply curve. So a demand shock, this is going to be something that happens that affects the demand for goods and services. Now, you could have a positive demand shock and a negative demand shock. Okay, your book talks about a positive demand shock would be like a reduction in taxes, reduction in tax rates rather, increases in the money supply, increase in government spending. All right, think about a decrease in the tax rate. Now, this doesn't always work, but think about a decrease in the tax rate. What if taxes went down? There are some politicians that are strong proponents of something called the flat tax. And let's say they established a 15% or a 10% flat tax. Well, that's a lower tax rate for a lot of people. And so if you had let's say a 12% flat tax, then people that are now used to paying 28% taxes are going to have more money to spend. And that's what they would do. That would have a positive effect on goods and services. You could also have a negative demand shock, and it would be the opposite, an increase in tax rates, for instance. I'm not going to argue with people about the importance of taxes. I mean, we need to pay taxes. There's goods and services that the government needs to provide. We would probably disagree on where that service should stop or be extended to, but health, education, welfare, defense, there are lots of reasons why we should pay taxes. I want to pay taxes. I just don't want to pay too much taxes, right? I need to Here's the idea for me. I don't know if you have children or not, but let's say your children, you give your children an allowance. Let's say you give your child $10 a week or something, okay? $10 a week. And you say, make it last, okay? This is for your spending money, $10 a week, whatever it is. What if your child came to you on Wednesday of every week, said, hey, I've spent all that money, I need you to give me some more, okay? Well, you might do it once, you might not, but certainly you wouldn't want to do that every time, would you? And so that's kind of where I am on taxes. I don't mind paying taxes as long as, just manage the resources. Manage the allowance that I'm giving you, Uncle. Okay? Make it last. And when you go spend too much of it, don't come back looking for more. Okay, that's just me. All right, that's a demand shock. A supply shock is something that's going to affect production. It's going to affect supplies. One way, if you think about a commodity, think about oranges or something, orange production. So I think that, it's usually like in Texas and Florida, and I don't know if they make, I guess oranges maybe in California, wherever the climate is right for oranges. Okay? Well, you know what? What if there was a very peculiar, unexpected freeze in Texas? And just as the orange crops are coming out of the ground, it freezes. It snows, and snow stays on the ground for 3 days. And it destroys all of the orange trees or orange production. See, that's going to have a huge impact, isn't it, on supply. And so we would expect, boom, that's a negative supply shock because it decreased the supply of oranges out there. So holding demand constant, if there's less supply, that's going to drive up prices. All right? So just know a little bit about supply and demand shocks. They said that demand shocks are usually characterized by aggregate output moving in the same direction as interest rates and inflation. They give us a couple of examples there. Supply shocks, they say, aggregate output moving in the opposite direction. So, for instance, on the output, let's see here. They were again, if we talk about demand shocks, they say, for example, a big increase in government spending. That tends to stimulate the economy. So the government starts spending a lot of money. That has a tendency to increase GDP. Okay? At some point, it's going to maybe increase interest rates because it increases the demand for borrowed funds by the government. All right? So that shows interest rates and inflation moving in the same way. let's talk about fiscal policy and monetary policy. Now, both fiscal policy and monetary policy are referred to as demand-oriented tools. Demand-oriented tools. Now, you remember a little bit about fiscal policy, I bet. Fiscal policy is the responsibility of the government, Congress. Monetary policy is the responsibility of the Federal Reserve. And both Congress through fiscal policy and the Federal Reserve through their monetary policy can absolutely impact the economy. Okay, they can stimulate or they can slow down the economy. All right, so and they do so by focusing on demand. All right, so let's run through the main fiscal policy and monetary policy tools. Fiscal policy, well, we tend to say the main fiscal policy tools are taxation, government spending, and debt management. We've actually already talked about all three of these in one form or another. Taxation, we already talked about. The government, the Congress controls tax laws, right? They can change taxes. They can increase, they can decrease taxes. And so taxation is a fiscal policy tool. And again, the idea is that if the government would decrease taxes, then that stimulates demand, we think, because there's more money that we have to spend. Instead of giving it to the government, we can spend it on our own items. Now, that doesn't always work the way Congress wants it to. Years ago, when George W. Bush was in office, there was a tax. I don't know if you remember, but for the year, spending was less than what came in. There was a budget surplus. Now, a budget surplus, when you've had as many years of a budget deficit as we've had, a budget surplus is sometimes, it sends the wrong message. It sounds like, oh, finally, good, we're out of debt. No, we're not out of debt. It just means this year we didn't have to borrow any more money because we had enough, because there was more that came in than went out. Okay, so there was a budget surplus. And so what did we do with that surplus? Well, Congress and the Oval Office, they wanted to try to stimulate the economy, and they wanted to give it back to the American people. And I think the average I think the maximum that went out was like $600. So I think a family married filing jointly maybe got a $600 check in the mail from the federal government. Well, what the government had certainly hoped, I think, was that we would all go spend that money, right? Let's go spend it. Let's go buy some goods and services, stimulate, and that would help stimulate demand. Well, it didn't have the impact that Congress expected. People didn't spend it as much as they thought they would, or to the degree that they thought they would. Many of the people who received that actually invested it or put it in the bank. Right? And so it did not have the stimulus that Congress and President Bush had hoped it would have. Okay? So in general, yeah, taxation, lower taxes stimulates demand. That's the idea. If they increase taxes, it's probably gonna reduce demand. All right. The second one is government spending. We already mentioned that one. The more government spends, the more they have to borrow. No, I'm sorry. I'm getting on the wrong one. Government spending. When the government is spending money, if they're spending money and buying U.S. goods, that's stimulating the economy. The government spends a lot of money, don't they? Think about it. When they're building roads, when they're building highways, when they're buying equipment, when they're buying airplanes, and so forth. They're spending money, and so the more money that is spent, that stimulates demand. Debt management, well, again, we mentioned that one. If the government spends more than they have coming in, then they have to make that up. They have to borrow that money. And the more money that the government borrows, the less money that's available to the rest of us. I mentioned maybe early on something called the crowding out effect. I think it was in an early chapter, but if I didn't, no big deal. The more of the credit that our government needs to borrow, then there's less credit that's available for businesses and consumers. The government essentially crowds us out of financial markets, and it causes interest rates to increase. So those are the main fiscal policy tools. Let's look at monetary policy. Monetary policy is the responsibility of the Federal Reserve. And the main monetary tools are the reserve requirement, I'm getting lazy. Open market operations, the Federal Reserve discount rate, and the interest rate that they pay on excess bank reserves. Okay, we'll start with the reserve requirement. The Federal Reserve requires banks to keep a certain percentage of their deposits, the money they take in from depositors, keep a certain percent on reserve with the Federal Reserve Bank. Okay? Well, that's important, isn't it? Because that provides some stability. It provides liquidity to the markets. If there happened to be a run on banks, at least there's some liquidity that the Fed is going to have. So the Federal Reserve, through their monetary policy, they can affect the interest rates. Let's remember, here's price and here's quantity. Here's our supply curve. Here's our demand curve. So let's hold demand constant. If the Fed increases the money supply, that means the supply curve shifts to the right, and you'll notice where the two curves cross is at a lower point. So when the Fed increases the money supply, it's going to decrease interest rates. If, on the other hand, the Fed were to decrease the money supply, now look where these curves cross. They cross at a higher point. And so the price of money, which is the interest rate, would increase. Well, the Fed, through their open market, or rather through their reserve requirement, they can affect the money supply. Let's say, for instance, 10% is the reserve requirement. All banks must keep 10% on reserve. And then the Fed changes their mind, and they said, let's change it from 10, let's make it 11. Now banks have to keep more money on reserve. That's less money that they can lend out, because now they have to leave more of it on reserve with the Federal Reserve. So since they have essentially just decreased the money supply, haven't they? That has decreased the money supply because there's less money that banks can lend. That's going to drive up interest rates. If, on the other hand, the Fed had gone from 10% to, let's say, 8%, well, now banks can loan out more money. They don't have to keep 10% in with the Fed. They only have to keep 8%, so they can loan out that extra 2%. That's going to increase the money supply. Open market operations. Okay, That's activities of the Federal Reserve buying and selling government securities. If the Fed, think about it, there's two sides here. I'll put right here, this is going to be a security. I wish let me do that differently. Oop. This is a Treasury security. And this is money. Okay? So, if the Fed is buying government securities, then they're basically taking money, increasing the money supply. If the Fed is buying government securities, they're taking money, they're putting money in the economy and buying these government securities and taking them out of circulation, basically the securities. If the Fed sells government securities, if the selling activity, well, what they're doing is the Fed is taking money out of the economy. When the Fed is selling government securities, they're basically trading government securities for money, and they're taking money out of the economy. And so you can follow then our supply and demand curve over here. If the Fed is increasing the money supply, then the supply curve shifts to the right, and it's going to lower interest rates. If they decrease the money supply, it's going to increase interest rates. The next one we have is the Federal Reserve discount rate. Now that's the rate that the Federal Reserve charges banks when they borrow money from the Fed. So why would a bank need to borrow money? It's because they don't meet their reserve requirement. Here we are at the end of the day, and a bank is supposed to have, let's say, 10% on reserve, and they don't. They're going to have to borrow that money. Okay, so they can borrow the money from the Federal Reserve. It's called at the discount window, and they're going to pay the Federal Reserve discount rate. Most banks do not borrow from the Fed. Most banks borrow from each other. Now I'm going to come over here and put not the same as Fed funds rate. But most banks actually borrow from each other. And the rate that banks charge each other is the federal funds rate. So even though the Fed tools are the reserve requirement, open market operations, federal funds, and the rate on excess reserves, and what we hear about is how the Fed increases or decreases the interest rate, just so you'll know, they usually target this rate. They target the federal funds rate, but they don't directly control the Fed funds rate. They directly control the discount rate. They make the decision to increase it or decrease it, but the rate that they target is the federal funds rate, and that's because most banks don't borrow from the Federal Reserve. Most banks borrow from each other. So they use the other tools, specifically the open market operations, to try to actually nudge the federal funds rate in the direction that they want it to go. They can also use this rate on excess reserves to do the same thing. So back in, I think it was 2008, the Federal Reserve started paying interest rate, not on the required reserves that banks keep, but some banks would keep extra reserves. So to encourage banks to keep extra reserves overnight, then they started paying an interest rate, a very small, I'm sure, but they gave banks an incentive for keeping money out of circulation, for not loaning out that last dollar. And so they started paying an interest rate on excess reserves. If the Fed wants to decrease the money supply, now look at my chart up here. If you decrease the money supply, it's going to increase interest rates. All right? So if the Fed wants to decrease, if the Fed does or wants to decrease the money supply, They could do that by paying a higher interest rate on excess reserves. Banks now have less of an incentive to loan it. They'll just keep it overnight at the Federal Reserve, and it decreases the money supply, which of course then drives up interest rates. So those are our monetary tools. And we said fiscal policy and monetary policy are both demand-oriented tools. So what in the world is a supply-oriented tool? What's supply side policies? Well, I would imagine, I don't know how old you folks are, but most of you would probably be too young to remember the Ronald Reagan era, era. When Ronald Reagan was running for president, and then when he was president for 8 years, one of the things that he pushed and the Republicans were pushing at the time was something called supply-side policies, supply-side economics. Okay? And supply-side, whereas demand-side politics is meant to stimulate demand, supply-side economics focuses on trying to give producers incentive to produce and develop goods. Okay? To produce. If you will give producers more incentive to produce. Think about trying to give manufacturers more incentives to manufacture. What comes out of that? Well, jobs to start with. You can't produce more unless you have people working for you. And so if we would create an environment that is going to encourage production and encourage employers and help them be profitable, then more suppliers, more producers are going to want to produce. And when they produce, they're going to hire more people. And when they hire more people have more money to spend. And what are they going to spend it on? Goods and services. That's the whole idea behind supply-side economics. And it was a huge Reagan push. So there were different names for supply-side economics. If you were a proponent of it, you called it supply-side economics, or maybe you called it Reaganomics. Reaganomics. By the way, when I first came to Murray State University 14 years ago, there was a young lady in the first year or two that I was teaching. I am not kidding you. Her name was Reaganomic Jenkins. And by the way, she was an economics major. But Reaganomic Jenkins was her name. And her parents were big fans of, guess who? Ronald Reagan and his economics policies. Reaganomic Jenkins. Really smart young lady, really nice. Okay? Anyway, that's our supply side economics. Now, if you happened to be on the other side of the aisle and you didn't buy into the Reaganomics, supply side economics, they called it trickle-down economics. Another name for it, they called it was voodoo economics. Well, you know what? It's real easy to pick things apart, isn't it? But again, the idea of supply side is that you don't go directly to demand, give the producers the incentive to produce. Okay? And then that is going to help the economy. Yeah, I get the idea that it does kind of sound like trickle down, but you know, you got to start someplace. And here it was trickle down because you help the businesses produce, businesses have incentive to produce, businesses are profitable, businesses hire more people, and yes, it's going to help the economy because the economy will grow because people will go to work and so forth. Okay? So voodoo, trickle-down economics if they were against it, Reaganomics, supply-side economics if they were for it. Anybody that wants to do any more research on it, you can look up an economist named Arthur Laffer. I think it was Laffer, I think, who it was kind of like one of those on the back of a napkin kind of discoveries that he started thinking about. And he drew his Laffer curve on the back of a napkin, supposedly. Okay, let's see here. By the way, again, not to get into a political discussion here or political argument, because there's enough of that going on in the real world. But I do want to make a comment here without trying to sound like I'm being any particular party. But, Republican or Democrat, I don't care. What I care about right now is the economy. And so you can agree or disagree. I'm just going to comment on the Affordable Care Act. Okay? I'm not going to argue with you on whether or not it was a good thing or a bad thing. I get the idea. I get that. I hate the idea that anybody in this country wouldn't be able to have health insurance. That's horrible. Everyone should have some level of protection. Okay, so I won't disagree with. That's what I think. But I also think that since we're talking about supply side economics and giving people or giving businesses incentives, I don't see the incentives. I see that a lot of regulation has been pushed to the businesses, small businesses in particular. And so when you look at all of the regulations, I get that certainly there's some social things that we need to take care of. But whether it's the Democrats or the Republicans, when the politicians start thinking, hey, I know the way to make everybody pay for this. How are we going to pay for this program? Hey, let's put it on the businesses. Let's increase the business tax. Let's make businesses pay for health care. Let's make businesses do this. Let's increase the cost of doing business. Folks, that has absolutely a huge disincentive for production and productive capacity. And I think in the long run, it's going to hurt this economy. So, Democrat or Republican, we can't put everything on the backs of business, big or small. Okay, got it off my chest. Thanks for listening. All right, let's see, moving on here. The next thing that we see then are business cycles. And I've already talked about business cycles. Okay, but if you look now, I'm on page 566, 567. Now they're showing the business cycle. Actually, they don't even draw it that way for anybody, but they do talk about business cycle, peaks, trough, expansions, recessions. The other thing that they talk about here are different types of industries. All right, so I'm going to come over here to the top. I'm going to write them as I see them. I see the term cyclical. I see defensive. Actually, I guess that's all I see right here. And I want you to know the difference in these. So if you've got an industry that is cyclical, that means it follows the business cycle. It means it's going to do better in an expansion and not as good in a contraction. Okay, so something that is cyclical is really, really sensitive to the state of the economy. It may be that producers of steel production, heavy equipment, probably does better on this side. And then in a recession when people aren't building and needing as much steel, as needing as many conveyor belts and so forth, it tends to slow down. And then when the economy comes back again, boom, they're doing well again. Home building is a cyclical industry because it tends to do well over here in a low interest rate and environment in an expansion, and it doesn't do as well over here, does it? Because now interest rates are really, really high, unemployment starting to rise. People don't need to be buying new houses if they're not in a good place. The next one we see here is defensive industries. That doesn't mean defensive like the defense industry. It means it happens to produce a good or a service that is going to be pretty solid, pretty consistent in every phase of the business cycle. There are certain things that consumers are going to continue to buy whether we're in expansion or a contraction. whether we're at a peak or at a trough. For instance, tobacco products. People that smoke don't stop smoking in a contraction or recession. People that drink beer don't stop drinking beer, I don't think. In fact, they may drink more beer and smoke more in a recession. There are certain things, pharmaceuticals. We're going to go buy toothpaste. We're going to buy groceries. We're going to buy milk. There's certain things, staple type items, we're going to buy regardless of where we are in the business cycle. Even, you might even think, what about entertainment? Your book says things like movie theaters are actually pretty defensive, pretty solid, because even in a recession, people still need some type of entertainment, a distraction, and they often substitute, like going to the movie for instead of going to Disney World this year, right? So they'll find some substitutes like that. So the point is that not all industries, not all companies are going to react the same in an expansion or in a contraction. Every now and then I'll have a student that when I ask a question on an exam, to like discuss maybe a defensive, they call it counter-cyclical. And that is not correct. A defensive stock is not counter-cyclical. I will admit that when you are in a contraction over here, you might go, wow, I sure wish I had more defensive stocks. But that doesn't make it counter-cyclical. A counter-cyclical argument would say it does great in a downturn and poor in an upturn. And that's not correct. A defensive stock is just kind of steady performer. Steady Eddie, right? It might climb a little bit over time. Procter & Gamble, Johnson & Johnson, grocery store stocks, Walgreens, things like that. They're going to be pretty solid. Their profits are going to be pretty solid, pretty predictable, regardless of where you are in the business cycle, because people are going to buy those products regardless. Okay? So your book then talks about defining an industry. Okay. Tell you what, it's been about an hour. I think I'm going to stop here for this discussion. And so the next thing that I will talk about, whenever I decide to do it, will be on, actually there's not a whole lot left. So I'll tell you what, I changed my mind. I'll keep going. I'll just finish this chapter. All right. So, industry analysis. Let's focus on the industry. There are certain things that we want to look at. We need to understand, and your book does a nice job of going through many different industries like money center banks, construction, utilities, auto, trucking, biotech, food, asset management, business software, oil and gas, telecom, computer, home improvement, pharmaceuticals, aerospace, health care plans, chemical, application software, restaurants. So many different types of industries. And what we know is that all those industries, they have their own characteristics, and they react different ways at different phases of the business cycle. One reason why, or actually, what does it say? 2, 1, 2. They say there's 3 factors that determine an industry's sensitivity to the business cycle. First is sensitivity of sales. So the examples we were just talking about, home building, for instance, they're going to be highly sensitive. So in an expansion, we would expect home sales, home construction companies to do better. Sales are going to be higher. But in a contraction, people don't go out. That's not the first thing they're thinking of. Honey, I just got laid off from my job. What are you going to do today? Let's go buy a house, right? That's not likely to happen. So there's certainly some industries that are very sensitive to sale and others that are not. Tobacco products are not very sensitive to sales. I'm sorry, I said that wrong. Tobacco sales are not that sensitive to the business cycle. People are going to buy tobacco products. People are going to go to movies. People are going to buy milk. Okay? So those sales of those products or those firms or those services or those companies is not going to be very, very sensitive to the business cycle. The second factor that they talk about is operating leverage. If you remember to a finance or an accounting course you had at some point, when you talk about your firm's total cost, cost can sometimes be divided up into fixed and variable. Most firms have some level of fixed costs and some level of variable. You're not likely to find a firm that has all fixed costs and all variable costs, right? But the proportion of each could be different. For instance, there are some firms that are going to have a high level of fixed costs relative to their variable costs. I would think heavy manufacturing, for instance, is going to have high fixed cost. Okay? Whereas something else is, is going to have something that doesn't have quite the investment in infrastructure is going to have more variable cost. The more hourly laborers that a firm has. See, hourly is going to be a variable cost to some extent, unless they're under contract for the year. But I mean, you think about production. If a firm needs to cut back their production, sometimes they say, hey, I'm sorry, we're going from 3 shifts to 2 shifts or from 2 shifts to 1 shift, right? Right away, boom. They cut back. They don't cut back on the conveyor belts, right? That's a fixed cost, but they are able to cut back on labor costs. So there's that relationship between fixed costs and variable costs. And firms that have higher levels of fixed costs have what's called a higher degree of operating leverage. A higher degree of operating leverage. If you've got a high level of fixed cost relative, and that means lower variable cost per unit, then man, you got to have a lot of sales to cover your fixed cost. That's the bad news. But the good news is that after you've covered your fixed cost, more and more and more of every unit that you sell goes to profit. A higher percentage of your sales goes to profit. If, on the other hand, you have low fixed costs but high variable costs, you have a low degree of operating leverage. Okay? So there is something called your contribution margin, which is your price per unit minus your variable costs per unit. You're going to have a very, very low contribution margin. I mean, you might have to have tons more sales, a lot of sales, in order to be able to break even. The third factor they talk about is financial leverage. Okay. And, financial leverage has to do with, actually it's similar in a way to operating leverage, because operating leverage had to do with the level of fixed cost versus variable cost. Financial leverage has to do with the level of fixed cost financing. For instance, like bonds, like debt. And so the more debt the firm is using, the higher the level, the degree of financial leverage. Okay, the higher the degree of financial leverage. Next thing, your book talks about sector rotation. So we just got through talking about how not all industries react the same way in the different phases of the business cycle. Okay? If you'll look on page 578, there's a couple things you're going to see. Number one, you're going to finally see the the business cycle that I drew. And you're also going to see something that I'm going to do a very, very poor job of trying to duplicate. Don't rush me, though. Okay, not the greatest work I've ever done, but this is going to be our contraction, and this is going to be our expansion. Okay, and what we see is different industries we expect to perform at different levels. So let's start with our expansion. Let's look at the beginning of our expansion. Right here, this says consumer discretionary. Then we're going to move on into materials. Keep going in our expansion. Now we probably maybe move into industrials. So these are some sectors that we would expect to perform as we move through our expansion phase. We might shift money, depending upon how long our expansion is, into those different sectors. As we hit our peak and now move into our contraction, we're thinking, well, let's keep money in healthcare because people are still going to get sick. People are still going to buy their staples, like that says staples. I'm going to have to erase that. Like oil, not oil, like milk, groceries. Let's tobacco type things. Then we'll move on into utilities. Then we move into the financials. Okay, and so again, this is sector. I'm not saying this is definitely not a passive approach. This is kind of a market timing type approach. And so there's going to be some risk there, and it assumes that markets aren't perfectly efficient. But again, sector rotation is trying to be really move money into the industries or the sectors that we expect to perform better or worse at different phases of the business cycle. Okay? Your book talks about an industry life cycle, not a big ticket item, but I'll try to draw it for you here real quick. And so we see this is the rapid and increasing growth. We've got stable growth. Slowing growth. This is going to be minimal or negative growth. And so this is telling us that, different industries go through a certain life cycle. Okay? At the very beginning, it says rapid and increasing growth. That's a brand new industry. There's a lot of excitement. Once there's usually just a few firms, but as those firms start having some success, having some sales, moving towards becoming productive and profitable, more companies are going to enter that industry. The products become accepted. You move on into a stable growth at some point. I mean, we could be talking the span of 5 years. We could be talking the span of 20 years. Okay, depending upon the industry. Growth is going to slow, and then finally there's going to be minimal or negative growth. I don't know what industry we could talk about that would be a perfect fit. The one that comes to my mind right now is movies. Watching movies, the distribution of movies. When I was when I had graduated from college and was working in real estate in Houston, Texas, I can tell you there was a video store practically on every corner, it seemed. And so just think about how the distribution of movies has changed. Okay? Now, you got Redbox, you got Netflix, you got on demand. I mean, you can see it on your computer. So I'm not quite sure where we are in the movie distribution business, but I would think getting movies on DVDs right now, we still do it in my household. We go to Redbox. My wife actually still goes to a video store. Just think about the life cycle there. My thought is on the video store side, we are in the minimal or probably negative growth side on that as we lean more and more on the digital distribution of movies. Let's see here. What else can we talk about? So this was the startup phase. This is the consolidation, maturity, and finally relative decline. The last thing I'm going to mention, and I often ask this on an exam in the case you're interested in, is talking about Michael Porter and the Porter's 5 forces model. And what Michael Porter developed was this discussion on the relationship between industry structure, competitive strategy, and profitability. 5 determinants of competition, he says. One is 5. So again, these are the 5 determinants of competition. Threat of entry from new competitors. Rivalry of existing competitors. Availability of substitute products, or rather, more specifically, the price products, the price pressure that you get from substitute products. Bargaining power of buyers and bargaining power of suppliers. So you could apply this to any particular industry. Let's take, for instance, how about coffee? Okay, coffee shops. You got Starbucks, you got Dunkin' Donuts, you got there's all kind of different, I guess, coffee shops out there. Let's talk about coffee shops. Is there a lot of threat of entry from new competitors? Absolutely. You know what you need to start a coffee store? A coffee pot, coffee, some water, and a cash register, I guess. Yeah, you could start selling coffee. So yeah, there's a lot of threat. So what you have to do, what you'll find, is strategy. Then you have to focus on strategy, trying to differentiate your product or your service from everyone else. Starbucks has done that, I think, very, very effectively. Okay? I mean, look, if you're a coffee drinker, personally, I think Starbucks coffee is great. I mean, consistently great. Yeah, it's expensive. It is. But it's consistently great. All right? Rivalry of existing competitors. I don't really see it with coffee. Starbucks is not running ads trying to slam Dunkin' Donuts, I don't think. And, when you see Coke and Pepsi, you see Verizon and AT&T and T-Mobile. I mean, those are competitors, right? When you start featuring your competition in your own ads, oh yeah, there's some competition. There's some rivalries. The threat of substitute products. tons of substitute products for coffee retailers. I mean, yeah, coffee's great, but it's not the only beverage out there. They face competition from energy drinks, from soda, from tea, smoothies, right? Bargaining power of buyers and bargaining power of suppliers. I don't think there's no bargaining power of buyers. I mean, I'm a buyer, and I can't go in and negotiate the price of a venti mochaccino or whatever those things are called. I have to pay the price. No, bargaining power of buyers would be if you were like the big buyer. You're Walmart. You get to buy. You get to go, okay, I'll take 7 million of those, but here's the price I'm willing to pay. That's some pretty significant power. I don't see it with coffee. Bargaining power of suppliers would be another one. If you are one of like 2 or 3 microchip manufacturers in the world, my guess is you've got some pretty good bargaining power. Okay, I'm not sure about Starbucks. I wouldn't think so unless the coffee beans they're buying are in great demand. So you could apply this concept to any industry. We could apply it to handheld devices, telephones, mobile phones, cell phones, whatever you want to call them. Shoes. I'm looking out the window, trying to see something that grabs me. Automobiles, right? We could apply it to any type of industry. Okay, aren't you glad I went ahead and did this? That was another 20 some odd minutes, but I went ahead and finished this chapter. So that, folks, is the end of chapter 17, just to kind of guide you through the discussion and your reading. And that's it. See ya. Bye.